Hey guys, it's Chris Mancola with the Mancola Group over at West USA Realty, and I'm doing our weekly market update. Just wanted to jump right in here and share my screen with you. I'm going to be giving you some really additional information on the market straight from Barry Habib, Logan Mohtashami, two of the best guys out there. Barry Habib has won many awards, but he's like a three-time Crystal Ball award winner, which basically means that when he says something, it typically happens. He's also been appointed recently to the Fannie Mae board after discussions with Treasury Secretary Scott Bessent and Bill Pulte over at FHFA. And he's got some great insights I'm going to share with you, along with Logan Mohtashami. So he also, Barry Habib also helped credited with stabilizing the housing sector and mortgage sector in 2020 uh, with uh, with congressional presentations that he did. So, uh, whoops, sorry about that. Let me get rid of that. We don't need that call coming in. Okay. All right. So, I'm going to share my screen here with you and jump right in. So, we've got Fed governor pushes for aggressive rate cuts. Uh, CFPB to close down. So we've got Stephen Myron warns of an urgent need for cuts and wants the Federal Reserve to go big at its next meeting. Plus, a key housing bill advances. CFPB nears its final days. So that's good news because that means less regulation with the CFPB. Thank you. The whole Dodd-Frank mess was part of that. So also, less regulations, less red tape, good thing in my opinion. We also have in the news Fed Powell, and he's going to be gone in May, thankfully. But Fed Powell suggests a tightening program could end soon, opens door to rate cuts. So suggests tightening program, meaning that he's had the stance of quantitative tightening, and he's saying we could see quantitative easing going on. Federal Reserve Chair Jerome Powell said the central bank is nearing a point where it will stop reducing the size of its bond holdings, but gave no long run indication of where interest rates are heading. Um, why am I not surprised about that? Though balance sheet questions are in the weeds of monetary policy, they matter to financial markets. Powell generally stuck to the recent script on the economy and interest rates that policymakers are concerned that the labor market is tightening and skewing the balance of risk between employment and inflation. So their dual mandate is labor and inflation, full employment and inflation, making sure inflation's down and we have full employment. And, ever since 2022, bottom line, yeah, prices went up, but interest rates went up at the same time, along with all the inflation. So it hit everybody's pocketbook. And we're still, have the after effects of this with them holding on to this stance. And I think it just basically has to do with the fact that you got to understand Jerome Powell is not actually an economist, number one. Number two, he was wrong when it came to, inflation being transitory. It was not transitory. And he just doesn't want to have inflation get out of control again. And he's super scared of pulling the trigger. I think that's what it comes down to, along with some politics. That's again just my opinion. Logan Mohtashami says all this talk is neutral, meaning neutral policy. Getting rates to neutral would be around the 3 mark, okay, for the Fed funds rate, which indirectly affects mortgage rates. Nothing ever of accommodative, which would be lower than that level. They will save that for when jobless claims break. Now, what would be jobless claims breaking? Well, we're not even getting jobs reports right now. Now, there are some ways that we can get some indicators, maybe from ADP recently, which isn't always taken with big in-depth insights. There's also some things that they can look at with some other indicators like from the IRS or whatever. But then we and tax stuff. But even they're not working either. So we're kind of in limbo till we get those numbers pushed out. So we'll see how long this government shutdown goes on. But like we already talked about, we could see this government shutdown. You know, go on for a while, or it could be done next week. So we'll see. We'll see what happens here. There's been speculation that after this weekend they may come to an agreement. So we'll see. But like Barry Abib says, we'll have to kind of see where this goes. It could, it's already kept helped to keep interest rates lower with the bond market and stuff. So like we already talked about. Also, uh, we have the idea of bringing Fannie Mae, which I don't know if anybody realizes this, but Fannie Mae is basically dominates the market. They are 80% of the mortgage market, providing, big time stability, lower interest rates, with the implicit government guarantees, and broader credit access. Without them, rates would rise significantly, harming affordability. So me, along with a lot of other people in the industry, we feel like this is a good move with ending conservatorship. So we'll see how that goes. But I think being in the private sector is going to be a big win. But Fed Chair Waller, Walter Bloomberg says here, Fed Chair Waller, signals that he wants to see, neutral rates, neutral Fed fund rate, about 100 to 225 basis points lower than the current Fed's fund rate. And we've talked about that before. That's a stance. And I always bring this up because, again, trueflation, some people think it's no good. I like it because I've gone back and I've looked at their charts and they track very well for where we are right now. And this kind of really tracks with something that Barry Habib said this week. And that is that, they take more data points than even the Fed does and even the BLS does to look at their models. And right now, today, it shows, the Fed rate is at 2.01, 2.01. So the inflation rate, that's what they're calling in. So, one of the things that Barry Abib mentioned in his talk this week was that if you want housing affordability, yeah, we could use more units, help with pricing. But what we don't want are prices to go down. Okay, not people say, well, you're a realtor, you don't want prices to go down. Well, if prices go down, I could actually sell more houses, okay, and help people buy more houses. So that has nothing to do with it. What it has to do with the fact is people don't want to buy houses as the prices are declining. Okay. And you have issues with appraisals and all those sorts of things. But why would you want to buy an asset that's dropping? Now, you know, you've got what, 78 out of 83 years of housing tracked where prices go up, 78 out of 83 years. So 5 years, prices went down. So that's a pretty good bet. If you're going to be in a place 5 to 10 years, hey, I wouldn't rent. Okay, that's just me. People ask all the time, when should you buy? Well, this week was actually, according to Realtor.com, I put out another video on this, but this is the best week of the year to buy for 2025. Again, a little bit more inventory, a little bit more time on the market. It's better for buyers. They're getting, end of the year deals, concessions, all kinds of stuff, closing costs, all kinds of incentives from builders and sellers to get a deal done. But one of the things that the Fed looks at as far as their indicators are their labor. So if the labor market breaks, which means what, 4.5% is probably going to be an indicator of breaking, or 323,000 4-week moving average with the labor market. But the other part of it is, Powell came out and said his ridiculous thing recently where 0 to 50,000 new jobs is okay. absolutely ridiculous, absolutely nonsense. And he kind of put himself in a box where, he said, oh, labor market's fine, everything's fine. We don't, we're lower rates and all this stuff. And then, he got these horrible numbers and all these revisions coming at him. So he kind of looks a little foolish with saying all those things now. And these are things that we've been, talking about this whole time. But the also the thing that Barry Habib pointed out was, with critiquing the Fed's look on the inflation rates, is number one, you had the whole transitory thing, which wasn't transitory with Fed Powell and Janet Yellen and all that. But he said, current issues are exaggerated job numbers, multi-state postings, birth death model errors. Okay, phantom 1 million jobs in 2024 that weren't there. Portfolio management fees are figured in with CPI. Okay, and they're inflating the CPI numbers. So true core in CPI inflation, if you take those inflated numbers out, would actually be 2.1, which is basically what Trueflation is saying, not 3.1. Okay. Or PCE, at 2.5. So I thought that was pretty interesting. We've actually talked about that before with the portfolio management fees. And rather than doing the right thing and not, adding that into the mix, whether he knows what he's doing or not, and all that. But or if it's political, but that's where the Fed Powell's missing the mark big time. And we have a weakening labor market, so he's not he's not looking at these factors. He's doing a horrible job. And he did a horrible job before, and that's why the prices of homes went up. You had all this inflation, and a lot of that money that got pumped into the system went into the housing and mortgage market. So that's just the way it is, and that's the facts. Potential chair could be Kevin Hassett. We'll see. We'll see who it is, or Christopher Waller, maybe Michelle Bowman. We'll see how it goes. But he's done in May either way. But that could definitely improve things in the housing market. We'll see how that goes. Um, his prediction, his prediction on this topic, though, is that by the end of the year we should be in the fives. Okay, and over the next 6 months we'll be at a neutral Fed number. Okay, over the next 6 months. So we'll see how that goes. I think by the end of next year, we'll definitely, in the next 6 months, we'll definitely be in the fives, or by the end of the year, maybe, if they do the right thing with the right rate cuts. They were expecting 2 rate cuts this year, but they don't have the data, so we'll see how that shakes out while this government is shut down. Um, and then he points out another thing, which is demographics. You've got demographics drive demand, right? So millennials and Gen Z, median average ages are advancing. They'll form 8 million plus households as ownership rises from 33 to 45% by age 45. Okay. Younger cohorts, like he points out, people at 25 median age, 8% ownership right now. That could actually add 17 million over the next 10 years, totaling 1.8 to 1.9 million per year versus the 1.3 million home builds that we have. So, in other words, it's it's definitely looking up when we look at those demographics, and with rates being in a rate reduction cycle, and even Powell talking about going to quantitative easing. Okay, so uh, when people ask me, should I buy a home? Well, if you can afford it, and you're going to be in a place 5 to 10 years, yeah, you know. Right now, I think the average is about 9 years in a home. So overall, and owning a home. there aren't too many people out there that don't own a home and have wealth. Okay. It's still the number one way to build wealth over time. 78 out of 83 years, prices have gone up. Okay. If you listen to the mainstream media nonsense, and I've put up charts before showing every year over the last decade and a half of, all the stuff they would tell you, you would have, lost out on hundreds of thousands of dollars. So, home ownership does build wealth. A homeowner is 44 times more wealthy than a renter. Okay, on average. So, uh, when you look at that, the top two, two, three quarters of top earners' wealth come from the equity from their homes. So, when you're looking at the negativity in the mainstream media and the nonsense on TikTok, it's not really reality. Okay, so anyways, let's move on from that. Home builders unsold completed inventory sits at 16-year high. Housing markets define deals in the number of unsold completed new single family homes in July 2025 is at the highest level. Now, again, what's the good and the bad here? Well, for the builders, they're not gonna be building while this is happening with while the rates are still elevated a little bit. But it also means you can get a good deal right now if you're ready to buy a house. Okay. So, uh, if you wait a year or two, there's going to be more demand as rates drop. And salaries, that's also another thing, isn't talked a lot about. You know, everybody wants to make more money. Nobody makes enough money. All those things are a higher price. By the way, oil is now in the 50s as far as dollars per barrel. President Trump says he's working on getting gas down below $2 a gallon. If that happens, okay, that's going to be amazing because the price of everything will go down. He even said that he thinks they got a deal put together where they're going to have beef prices down. So that's nice. But if gas goes down, which it already has, we need to get it down more with what does that more supply, like, right? Supply and demand. So by producing more oil, we're going to see prices go down. That's a big part of the equation anyway. And a little less in some of the, environmentalist crazy regulations. So, but this is a great opportunity for people to go and buy a brand new home, get all the warranties, get all the incentives right now, and not deal with the demand and competition that's going to come along over the next, year, 2 years, and beyond. Um, so one thing that came up though is that looking ahead, the builders actually have some confidence moving ahead. And he wants, this is the head of the Builders Association. And he said that, he basically, wants to see this government shutdown end so we can get back to, to business. But the outlook is actually, as rates decline, they're more optimistic as far as the building association is concerned. So that's good news. Okay. Because we got to keep supply going. Otherwise, we're going to have a real problem. I saw this article. I just wanted to share it with you and let you know I did read into it. I also even, put out some feelers, and I was able to get a response back from Logan Monashami, and he said, this whole idea of, again, not saying that the economy couldn't be better, okay, but roughly it says roughly half of the U.S. states are effectively in a recession and hanging on by their fingertips. Moody's chief economist says. So he says that doesn't really apply to the general economy unless total consumption of real sales decline, which we're not seeing. Now, you can debate if that's the higher class that's, consuming all the goods, but in any rate, we see that the consumption has not gone down. Okay. Um, we always talk about this residential building construction. This has been going down. Okay. They're optimistic, but it's been going down. and all employees, residential building construction is down. So if they're not hiring or they're laying people off, when building needs to commence or ramp back up again as the demand goes up with lower rates and more affordability, that's obviously going to be a thing, right? So if we want stable prices, we need lower rates. I mean, basically the uh, prices on homes, besides the inflation, but the lower rates helped to shoot up, and we had lower inventory back then too, helped to shoot up the prices, right? But what's going to offset that and stabilize pricing is enough inventory. Now, right now we're at pre-pandemic levels, um, the low point of pre-pandemic levels. So we're nowhere near a crash or anything like that, but we're right, there where we can say, okay, we're pretty good on supply, but that could shift very quickly if rates drop again, which I think by the end of the year, we're going to see the average rate across the country drop to, being in the fives. You can get a lower rate right now with a mortgage broker. We have a great one. His name's Evan Einhorn with Modern Home Lending. We can get you interest rate buy downs on resale and brand new homes. So that's a thing. You can also assume somebody else's lower mortgage rate. Right now, 40% of homes owned out there are owned outright. So that's also a thing. And there's a large percentage of people with interest rates, that got in when the rates were, in the twos and threes. Um, we point these out because residential construction and manufacturing, they're both down. So, that's always an indicator prior to a recession. Now, these sectors aren't breaking. Okay. Those labor sectors are not breaking, but it's something that the Fed should be reacting to, I think, in a much bigger way. And so do a lot of other economists and even Fed governors. So, and like I said, as far as the inflation goes, that isn't a thing anymore. Now, the prices went up and the prices don't come down, but the rate of inflation has slowed. Okay. I know everything costs more. It's hard for everybody right now, but the rate of inflation has slowed to what Barry Habib said, right around that 2% mark. Okay. So, and along with trueflation, and so this whole, with those inflated numbers on inflation, we had the inflated jobs numbers. We are so far behind lowering the Fed's fund rate. Right now, we should actually be at this point now at an accommodative stance to get the economy going again. I mean, think about it. When those rates went up in 2022, it slowed down the housing economy. When you slow down the housing economy, you kind of slow everything else down because it touches so many other sectors of the economy. People, household formation, they get married, they buy a house, they buy furniture, they buy stuff for the house, they put in pools, whatever, all the things, they go to Home Depot, they buy food, all those things that people do when they get married and have kids. So it touches so many other sectors. The 10-year Treasury today, let's see, I think let's get the most up-to-date number here. Yeah, we just want to make sure. Yeah, we ended up at 4.005. We should be at about 6 if we were, it says rates hold steady just above 3-year lows. Today, the average 30-year rate is 6.23. Okay, so we should be, if the spreads were where they are normally, right around 6 or lower. If we were where we were last year with the spreads, let's see if I have it right here. Let me pull this back here. Yeah. The spreads have gotten way better. If you look at where the spreads were the last year or two, okay, they've gotten way better between the 10-year Treasury and the 30-year fixed. But the historic average should be right around 2% difference or 2-point difference. So if it's 4, it should be 6 or less. Okay. It should be 5.75 or 6 if things were perfect. But as the economy improved, we saw the spreads improve, and now we're here. So they're staying steady. If we get, those labor numbers and inflation numbers out. We'll see where they come out, and hopefully the Fed catches up. A big part of that inflation too that affects all this is shelter costs, and the Fed is way behind on that. I mean, it's so ridiculous how that's all gauged. It's a survey, and people are asked, how much you think you could rent your house out for. Most people don't even know that. Number one. Number two, um, that could be lagging by 12 to 18 months, that information. So, as far as the data that they're looking at in those surveys. So it's totally ridiculous. It's nonsense. Everybody in the industry thinks it's nonsense. But anyways, that's where we are. So um, on the forward-looking data, more updates on purchase application data, Logan Monashami put out, it had a decrease of 3% week over week, but we've had an increase of 20% year over year for people applying for home loans. Okay. And again, the reason why we look at this is this tells us about, where we are about 30 to 90 days out, because people apply for a loan, they got to find a house, go under contract. Then you go under contract, and usually a typical contract is 30 to 45 days. Could be a little bit longer if maybe you're trying to sell a property, or you've got other moving parts there, or maybe if you're getting into a new build, even if it's quick moving, it could be anywhere from 30 to 60, maybe 90 days, or you're building a property, or whatever the case may be. So, but at least 30 to 90 days, this gives us a pretty good indicator. So things slow down a little bit right now, time of year. People are like, okay, I'll wait till next year. I'll wait till I get, my taxes done. I'll wait till the spring when the kids are out of school, whatever, unless you're in a retirement community around here in the Phoenix area. Rates heading towards 6%. Things are moving. Looking out 6 months, it looks pretty promising when you look at the builder confidence. Again, working from the lowest levels, but they're up slightly. Present sales next 6 months. This is nationally, of course. Traffic of prospective buyers. So all these indicators are up. Okay, nationally. Okay. If we look at total housing inventory nationally, it's up a little bit. Again, this year to the low pre-pandemic levels. Okay. If we go back here, we can see how it kind of lines right up with that 2020, 2019, but the low end of it. Okay. Really quick, since we're talking about inventory and such, the days closed on market, you have 81 days closed on market. Okay. We're at about 43 days to get under contract in the greater Phoenix area still. Our list to sales price success, or list to sales success, meaning you actually sell the property, is right around the historic average at about 69%. Okay. Still sitting there. 5.2 month supply. That puts us kind of in our market a little bit more of an advantage to a buyer. Some people might say balance. It's pretty close to balance, but there's a slight advantage to a buyer. The absorption rate actually went up a little bit, and we'll see that down below. We were at 19%. List price, the average list price is $736,000. The average sales price is the actual sales price is $589,000, almost $590,000. And a list of sales price is still sitting at around 97.2. We usually like to see that around 90, a little over 98. But basically that means that sellers are either reducing their prices or giving up concessions, to buy down people's rates right now. That's very popular. ARM loans are very popular. Buy down rates are very popular and assumable. When I say ARMs, people think of the crash. These are not those loans. Okay. First of all, you still have to qualify, and you have to qualify for a higher interest rate in the end. But you have to qualify. Back then, you could fog a mirror and buy two or three houses. So totally different loan. If anybody's interested, please feel free to reach out. Our lender could definitely help you with that, or we can negotiate rate buy downs or get them through builders. Active inventory is actually up 1.4% at 25,964. The single family homes, I just checked it, we're at 19,400. So just for single family homes, but this is the total of all property types in the greater Phoenix area. Pending sales are up 2%, and closed units are actually down 1.5%. Okay. So that's a little bit that's a little bit promising there that we've got some extra. That means a little bit more people are out there looking and buying and going under contract. That's nice to see. The distress sales market, actually, short sales declined 2%. HUD is down 5%. Lender owned REOs, homes that didn't sell at auction, bank sales, those are up 5.1%, but nothing crazy as far as anything distressed. So, again, nothing happening there. Our inventory, again, even in the greater Phoenix area, even though it's a little bit more elevated than we've seen over the last couple of years, is actually, you know, we're not having an issue there. So, if we look at all of the price points, you can see days on market here. You can see the percentage of homes that are actually on the market per the price ranges. Okay. 31% of the homes, again, this price bracket always comes in at, the top end, typically between 400 to 600,000. Average home right now in the greater Phoenix area is probably right around 450 ish. So, we've got the next bracket down, 200 to $400,000 homes, and we can see actually the change in percentage over here of those numbers. There's not really a ton in the luxury market, unless you're between 1 million to 2 million. There's about 8% there. So, in any case, that is that. Let's see here. Okay, so the Cromford Market Index tells us if we're in a buyer or seller's market. Below 90 is a buyer's market. Over 110 is a seller's market. We are right now at 7.3, and we actually, let me see here. I actually took a note on this. The month over month change is actually negative 1.1, as far as it going towards a buyer's market versus a seller's market. Okay. So we've seen a lot of reds, down arrows in the different cities, as far as that goes. But 79.3% right now, that puts us below 90. So we're in a buyer's market. Our supply is actually pretty good. That's actually normal supply at 101, 100 being totally normal. And the demand is down about 20 points, 20%. Okay. So again, I think that's going to be fixed with getting into next year, along with, interest rates coming down, salaries increasing, all those things will come into play, and demographics. Okay. Demographics is destiny. Right now, our contract ratio, this is more of the right now, what's happening today. Even more so than the last chart. Active count is showing at 22,361. Under contract, 6,536. Okay. And that puts us actually in a warm, or just under a warm market. Okay. Just under a warm market. We're not quite warm. And we're seeing that on the map, everything is cold to warm, or just kind of balanced on the map here. So, guys, that's all I have for you today. Hope I didn't go too long for you. But if you have any questions, always feel free to reach out for home values, or if you'd like to start the process and get a little bit more information about selling or buying, or get pre-approved with our lender. We'd love to be able to help you out. Thanks a lot. We'll talk to you guys next time.